Securities offered through Kestra Investment Services, LLC, Kestra IS, member FINRA SIPC. Investment advisory services offered through Kestra Advisory Services, LLC, Kestra AS, an affiliate of Kestra IS. Capital Advisory Group, Inc. is not affiliated with Kestra IS or Kestra AS. Neither Kestra IS nor Kestra AS provide legal or tax advice and are not certified public accounting firms.
You work hard for your money. For the next hour, you're going to learn how to keep what's yours. Capital Advisory Group presents Keep What's Yours. Here is Josh Gilbert and Jeff Zufall.
Hello and welcome to Keep What's Yours with Jeff Zufall. I'm Josh Gilbert, sitting here with Jeff Zufall, Senior Tax Strategist and Wealth Advisor with Capital Advisory Group. Hello, Jeff.
Hey, happy Saturday.
Happy Saturday to you, too, and we are in the thick of it, off and running.
We are definitely in the thick of it.
We coming up on mid-February, and tax time is in full swing.
Yes.
Everybody should have their W-2s, right?
W-2 should be out. Most of your bank interest. Our things we're waiting for currently are your brokerage statements, your true 1099, DIVs, interest, so on and so forth. But they should be out shortly. I say shortly.
Yeah, well, we've talked about this last year. We talked about it the year before that. Don't file your taxes too soon because sometimes they only send you over some preliminary numbers. These are fat finger numbers.
Yes.
And then like 2 or 3 weeks later,
they'll send you the real one.
They'll send you the real number. Well, I've already, submitted my taxes with your preliminary numbers.
And sometimes it's a subtle change where they move interest income to dividend or vice versa, and it's a couple $100 back and forth, and that's it. But again, it's not if it's not reported correctly on a tax return, it's going to raise a flag at some point in time.
And the government gets the final numbers. So if your tax return doesn't match the government knows everything.
Yeah.
And we say this every week. Why don't they just tell me what I owe? It's never going to happen.
It's not
like
that
that.
easy.
The big tax preparer companies out there, they just don't want to give up their stranglehold on making it as difficult as possible. You exist, Jeff, to do our taxes, and I bet you exist kind of begrudgingly.
Yeah, kind of got into it. One, family business, didn't have any choice, kind of got pushed into it, I would say, at a young age, and was like, hey, okay. So, yes, kind of took the reins and ran with it. But the way we look at it is it's more of a tax planning. So, yes, we prepare your tax return. We get down in the trenches, this time of year. But the trick to it is whatever you do on a tax return or whatever you do in your financial life, the two crisscross, and they touch each other on a regular basis, whether you realize it or not.
So a lot of times we hear that our financial planners that we go to don't really touch on the tax end of it.
They talk tax planning, tax strategy, but at the end of the day, they're not signing your return and they're not doing your return. Yeah. So they could kind of vary a little bit. I see it all the time. Miscommunication. They say, hey, we're going to sell this. It turns out that it's a short-term capital gain. So a short-term capital gain becomes ordinary income. A long-term capital gain is basically, it's a 15 or 20% tax angle on it.
Right.
We see people show up all the time. They're like, hey, they did this trade. It was short-term, made a ton of money. We made a 30% rate of return in 6 months, but you got to pay ordinary income on it. So we see different stuff like that where it's a part of it's miscommunication. We see tons of people saying, "Oh, convert your Roth, convert your IRA to a Roth. That's the best way to go." Sometimes it makes 0 sense. You just incur a tax just for the luxury to have it tax deferred. Other times it works beautifully. So
yeah. So the idea of having the guy that helps you make your financial decisions is also the guy that's doing your taxes at the end of the year. Yeah. One-stop shopping.
Yes.
We could say, hey, let's sell this. And you could say, whoa. Yeah. Let's do the math on that.
We look at it in a situation like that. We look at it in two angles. One is, okay, you sold it or you want to sell it or we want to sell it for you. At the end of the day, what is the net effect? How's it going to, so you make a 10% rate of return, but you give 3% of it back in tax. Okay, I'll take that. Are there shares that you're sitting on that someday may come back. I hear that all the time, like, I'm waiting for it to come back to break even.
Right.
No. Sell it, take the loss.
Get it off the books.
Get it off the books, reset the deck, because the time that it takes for that stock to come back where it came from, you can put it in something else and make your money back.
Absolutely.
Again, it's the world of investing, so risk is always at hand, but that's the general consensus behind it.
But tying your money up in a loser when you can just, cut your losses,
call it a day,
get the cash back, and put it into something else.
Yes,
you can make more money doing that. Yeah. And then, what is the tax implications of everything?
Exactly.
Everything we do with our money has a tax.
At some point in time, it's going to hit your tax
somewhere.
Return.
So having someone make our financial decisions, keeping in mind the taxes.
What's the net? What's the net in your pocket?
Because the last thing I want to do is make financial maneuvers and then come and see you or my tax person and come to find out.
What'd you do? Why'd you do that? Yeah.
Well, if I would have known it would have made this big of a tax implication, I might not have made that decision.
Exactly. Or somebody calls and says, hey, I want to buy an RV. I need 300,000, 300, and I think it's 310, 315 is what the RV was, and they want to pull it from their IRAs. So not even thinking to get $300,000, we have to pull 500 from the account. Makes no sense.
Yeah, because you got to pay that much in taxes.
Now maybe do a down payment, finance it if you can, and then take monthly payments from your IRA to pay for it, and you're going to reduce the annual outlay from taxes. It's still going to cost you, but it's not as bad as taking $300,000.
Taking $300,000 big lump sum, that means you have $300,000 in income that year.
Yes.
And so what is your tax rate going to be? Well, it's going to be
up there
in the 30s.
Yes.
So why not just take, $1,200 out a month?
Exactly. Whatever that payment comes out to be, and we're waiting for those numbers back. But take that out of your IRA on a monthly basis.
And what's $1,200 times 12? $44,000.
Exactly.
What's the tax rate on $44,000? Well, some are probably in the 20s.
Exactly. But if you took $300, well, really, you'd have to take to pay the tax. You'd have to take probably $450.
Yeah. Well, see, they want $315 for the RV, and you take out $315, and then the government takes their taxes.
Hey, you owe us, $90,000.
Now all of a sudden, I'm short $90,000 at the RV dealership.
Yes.
So everything we do has a tax implication, and the whole point of Jeff Zufall, senior tax strategist and wealth advisor with Capital Advisory Group, the whole point is that he wants to help you understand what that's going to be. You can make up your own mind at the end of the day.
We'll show you the numbers. And again, math always wins.
Math always wins. Just say, hey, I want it, and I want it paid off. My wife's big on paying stuff off.
Yes.
But it might be smarter to take a loan.
Depends.
Take a mortgage out.
Exactly. You have to do the math on it to see where it comes out. One of the big things out there used to be is mortgage. Your home. We'd be like, mortgage it to the hilt. Why? Because you could itemize your deductions, and you could take a piece of that mortgage interest that you were paying and write it off. So literally the feds were helping supplement your house, whether you realize it or not. Now with the repeal of SALT, which is state and local tax, basically everything's capped at $10,000. There's times bulk people cannot itemize anymore, so it makes no sense. It's a real cost. It costs you, if you have a mortgage and it's a 3% interest rate, it costs you 3% to hold that.
And the idea that maybe, I've been doing this for years. Well, the laws have changed.
Exactly.
So unless you're, rolling along with the United States government and the tax code, you might not have known that it has changed.
Exactly. And you can't take that deduction.
You might be behind you might go in to do your taxes, and here's something that we've been talking about the past couple of weeks. You go in to do your taxes this year, and all of a sudden you owe money, whereas last year you collected.
Most people collected. We're seeing more people this year, normal, not people with capital gains and all kinds of crazy, but normal middle America, and their refunds are way lower than where they were last year, and are in some cases they owe a little bit of money. So big picture, don't expect to walk in and repeat what took place in 2021 for 2022's tax returns, because we're not seeing it.
It's just all of a sudden,
so, one of the big ones was, and again, it's not a big deal, but you got $300 or $600 for charitable contribution that you don't pay tax on. Every return that I see, people have $605 of charitable contribution or $320.
I got caught on that.
Can't take it.
Yep. I donated last year to Backstoppers, and I'll save the receipt. I'll give it to Jeff.
Yeah.
It's not a thing this year.
Yeah. So what we're seeing is, and again, it's a planning trick. If you have a corporation, not a sole proprietor or an LLC that's a single member, it's what's referred to as a disregarded entity, which means it falls back on your own personal tax return. You can't take a deduction there. But if you have a corporation and you want to be charitable, do it through your corporation. It's the easiest way to do it. An S corp, a real corporation, an LLC that's a real partnership has more than just you.
Yeah,
there's multiple people there. So that's a big one right there.
Child tax credits have changed.
Yes,
in the past year, we were getting kind of a bonus child tax credit through COVID. That ended, and this past year, it's not a thing anymore.
It's not, but in the State of the Union address, it was brought up.
Oh, yeah. We're going to talk about that.
So he, President kind of talked about it like, hey, help, families. So it's possible that that's out there on a drawing board someplace, and they're going to try and bring it back.
And we talked famously, Joe Manchin said, no, I don't want that inflated child tax credit every year.
He was adamantly against it.
It was always $2,000, and you got it at the end of the year.
Yeah,
and
on your tax return.
On your tax return. But through COVID, we were getting, for my son who was under 2, we were getting $300 a month.
Either got $250 or $300, depending upon the age of the child. And that was from July 15th, maybe July to December. No questions asked. You could bank it, get it on your return. You could take half in cash, get the credit. But we've defaulted, if you want to call it that, back to the $2,000 a child period. So on a tax return, you don't get cash.
Right. And for my instance, if we were expecting $3,600 back and we were only getting $2,000, that's a $1,600 swing.
Yeah. Take that times 2, 3, 4, 5 kids.
5 kids.
And it starts getting really expensive really fast.
Right. So a lot of people these days, as they're going in, what Jeff is seeing is people thinking that they will be getting refunds.
Yeah.
And they might actually be owing this year.
The refunds are reduced from where they were. And again, I'm not a big get a $10,000 refund from the IRS. Yes, it's for savings. There's better ways to do it. And again, you might have got a $6,000 refund last year and you're getting $1,000 back, and the clients, what'd you miss? That's
right. Well, we didn't miss anything.
We didn't miss anything. It's just the new setup
have changed.
And things have changed.
And again, I stress this all the time. The government will change the tax laws. Maybe they'll announce it. Maybe you'll see it on CNBC.
Yeah.
But nobody comes to my house to tell me.
Never.
Nobody came to tell me. I donated to Backstoppers when we did the Backstoppers radio-thon last year. We did it this year in January. We did it last year in January. I donated back then thinking I would get it. Well, lo and behold, you told me a couple months ago, no charitable deductions anymore.
So
I wish they would have told me.
So the concept is you look at most of the charities out there are these non-for-profits, and you go, ooh, is it going to hurt them this year?
Right.
Because, again, I think that's why when they changed the SALT, which is the state and local tax where you can't really itemize, a lot of people just quit giving because they weren't getting a tax benefit. So then they brought back I think it was in 2020, it was $300 everybody, just straight across the board, single, married, whatever. And then in 2021, they went 300 single, 600 married, filing jointly. And then in 2022, they just said, nope, don't exist.
Nothing. And Jeff always says it's not in your best interest to give a charitable donation as a financial decision.
Yeah, as looking for a tax break in a sense. But again, if it was
do it
on the
it's
table,
a good cause,
exactly,
and you want to do it.
But if it was on the table and it said, hey, you could give this money to this charity and get a tax break, or no, most people will say no and they quit. They won't do it.
Right.
So. Again, at the end of the day, you say how many of the non-for-profits and the charities are going to step up and say, wait, we don't have the funding we need.
give us that back.
Yeah, and then maybe they could push the issue to get the feds to say, hey, we'll give it back to you, or change salt. Again, that's been brought up multiple times. They've looked at it and they passed on it.
So 1099s, salt, charitable donations, this, that, and the other. People might start getting dizzy out there listening on their radios, and that's the point. This stuff is complicated. How do you navigate your way through it? Well, you have a buddy in Jeff Zufall to help you do it. And
exactly.
In most parts, do it for you.
Yeah.
You know, because a lot of these things, I come in, I just push all my stuff over to your side of the table, and I said, Jeff, call me when you're done.
Yep.
You know, you might have some questions, but
yeah.
The receipts in the shoebox, that is done. Don't do that anymore. That is a terrible way for you
Scan
to do it.
Upload it to Dropbox. There's so many of these different
create a spreadsheet, you know,
digital places, put it on a thumb drive, whatever the case is. And again, please don't bring me a thumb drive.
Right.
Our office policy is no thumb drives. We don't know where it's been.
But if you need to access it,
I have a notebook that I keep in the office that is unconnected to my server, that I could plug it in if I had to extract that data.
Sure.
But again, we don't really like it just because we have a no-click policy is what we call it.
I mean, you don't want to get a virus.
No, because I don't know where that thing's been. We used to give out the actual completed tax return on thumb drives, but yet said, hey, we won't accept anything on a thumb drive. So we had to.
But if you did need to see the receipts,
typically
keep them, have them.
Exactly. We could see them, but I don't need
Log
them.
them on a spreadsheet.
Yes.
And if the government comes back and says, well, we need to see this actual receipt, we know where to go to find it.
It's either the IRS or the state agencies that you would want to be able to present them a accurate receipt.
If needed.
If needed. Only if they ask for it, though. Mm-hmm. Only if they say, prove these deductions or prove this.
So jot down the correct numbers.
Yeah.
But just have, in a file folder somewhere, a backup to say, hey, the IRS is questioning this. Well, here it is.
My question or my concept is with the IRS hiring more people, at some point in time, they will get to the point where they start to reach out to people and actually say, hi, we're the IRS. We'd like to talk to you. It's a informal audit. Could be done by letter, could be in person. Typically, if you're in person, you're in trouble.
Yeah.
But save the receipts digitally because, again, you go get gas. If you're writing off gas and you get the little, I don't know what you want to call it, the little receipt from the pump, make a copy of it. It's 6 months from now, you won't even be able to read it. So if you save all your receipts and you go, hey, I got this giant file folder of all this stuff, but yet it's the receipts like that.
Yeah, those receipts fade over time.
They're blank.
Yeah.
So scan them, put them in Dropbox, put them in some digital format that you could reference. Hopefully you never have to ever open that file, but if you do, it's there. And then we have a digital vault that we use, and that's what we use the digital vault for, is have the clients upload their stuff or we upload it for them. And that way it's digital. If we ever need to go search for a 1099, a receipt, whatever the case may be, it's out there on our vault.
So that is kind of the idea, and we are going to talk about the IRS hiring more. Who is up for audit? Well,
no one.
Yeah. So we'll see how that all goes. We'll talk about it. It is Keep What's Yours with Jeff Zufall. The idea is that everything that you do in your life when it comes to money has some sort of tax implication on it. Are you taking the deductions that you can be taking? Are you making the right taxable decisions? I tell the story of my life and my son's schooling. Jeff, just the other morning, I walked in and I saw a new family there with a little newborn, and they were in the office talking. And I walked by and I overheard the mom say, well, we've got a flexible spending account, and it goes up to $5,000. And I'm walking my son to his classroom, and I'm thinking to myself, that's what we do,
That's
too.
right. That's right.
I wanted to go up and say, hey, we're one of those families, too. It's a way to save money out of your paycheck. It's pre-tax. It doesn't get taxed by the federal government.
Yep.
And as long as you use it to pay for schooling,
higher education, something down that path. You have healthcare too, which those are a little different from a standard HSA, but it's okay.
It will never be taxed.
Yes.
And that is something that the federal government is doing for our benefit.
Yes.
You know, what have you done for me lately? Well, you helped me keep $1,200.
That's right.
Last year and this year. And the idea being that I'm going to have to pay for school anyway.
Yes.
Might as well do it with tax-deferred money.
Yeah.
And the government says, fine, good.
Yeah.
We're glad that I always make the joke that when they see my tax returns, somebody runs over and rings a bell. Ding, ding, ding. There's someone's using the tax code to their benefit. You know, someone must have hired Jeff Zufall to set up their FSA for them. And you could be doing it too. Jeff always says if you aren't doing anything as far as your taxes go to keep a little bit more of your money, there's bound to be something out there.
Everybody can do at least something.
At least something. So we'll go to commercial break, but when we come back, State of the Union address. What was said and what do we need to know? And, you know, as far as interpretations go, what was the truth about some of these things that was said? We'll get to the bottom of that. Keep what's yours with Jeff Zufall. Capital Advisory Group. Here's the number, 636-394-5524. Give Jeff a call and just say, hey, I heard the show and I want to do a flex spending account. I want to do a health savings account. I want to keep a little bit more of my money. Jeff, hook me up. And we can get started.
We can do that.
Keep What's Yours continues with Josh Gilbert and Jeff Zufall.
Back on the Big 550 KTRS, back to Keep What's Yours with Jeff Zufall, Senior Tax Strategist and Wealth Advisor with Capital Advisory Group. Here's the number, 636-394-5524. We'll be giving it out often, and we'll be letting you know that if you aren't doing anything when it comes to tax mitigation in retirement, if you're not doing anything when it comes to minimizing your tax liability every 2 weeks when you get a paycheck,
weekly, monthly, however you get paid,
there's something you can be doing, and all it takes is a call to Jeff, 636-394-5524. Get an appointment on the calendar, go see him, bring him a couple years tax returns,
2 years tax returns, any of your financial statements that you have,
a couple of paycheck stubs,
probably two paycheck stubs, current paycheck stubs,
and you can even just eyeball it and say, well, you're not withholding enough.
Yeah. Typically, we can do it pretty quick. Size up what your return looks like if your income is the same, and we see your paycheck stub, and you've got a 5% federal withholding, could be an issue.
Yeah, and we've had somebody here at the station. I won't say what their name is, but they said I owe every year, and I'm sick of this. Yeah. What can I do? Can Jeff look at my stuff? I said, yeah, he could probably look at your paycheck stub and tell you. And
that's where it's at. Yeah.
Yeah. The first thing you thought was, well, they're probably not withholding enough.
Yeah.
So that's one thing that you might want to go into Jeff and talk about. If you're paying taxes every year, at the end you owe every year, you got to do something.
Yeah.
And no one gets to zero. It's not possible.
You could by dumb luck get there if you really, really, really planned as you went forward. But typically, most people's returns, there's too much going on. It's going to be, net zero is you owe $300 or you get a refund of $300.
Right. No one really can. It's just such a moving target the whole year that it's probably tough to get to zero. But the last thing you want to do is owe, $3,000.
Well, yeah, or 30.
Or 30 grand. Yeah, that's the last
I've
thing.
seen a couple of those, and I got to be the bearer of bad news.
Oh, that's terrible.
To say, oh, you owe a little tax, and here's, after they're done crying, I got to get the Kleenex out and then explain to them how we're going to address it.
Well, let's talk about that because there's a story that the IRS is hiring a bunch of agents, and they said, we're going to go after people who are either not filing proper tax returns or purposely trying to dodge their taxes.
Yeah, so that's what they're saying is small businesses, again, they say that, that it's only if you're over $400,000 is the mantra. that's the people that are going to get audited, so on and so forth. But some of these independent, I call them think tanks, the tax, whatever you want to call them, kind of the think tanks where they put stuff together and go, hey, this is really going to cost us, or hey, it's a net benefit at the end of the day.
Here's the proposal. This is what it would look like, boots on the ground.
They're coming back saying $200,000 or less, small business revenue of $200,000 or less are going to be the targets. So one of the first things I say that the IRS has thrown out there is basically that they are going on after tip wages that are unreported tip wages. So you go, they finally hired some people. You can say the phone's improved a little bit, but we haven't got that deep into it just yet. That's coming in the next couple of weeks where there'll be tons of questions and issues that have to be, addressed.
The IRS has hired 5,000 customer service reps because over the last year, if you called the IRS, only 13% of people actually got through to somebody.
Yeah. So you go, man, that's
pretty terrible.
That's terrible. But so here's the second joke that goes down that path. So Janet Yellen is our Treasury Secretary. She looks like your grandmother.
Yeah.
So she has vowed that she's going to increase basically their IRS's phone service, and she's going to get it to 85%.
So that's the target she's shooting for?
Most people would say, hey, we're going to at least get 100%.
I want to get 99% of every phone call, and anybody that doesn't answer the phone, we're going to fire them.
Yeah, and instead of shooting at 85. But hey, that's an improvement from where we were.
And you said that even 85% is probably too optimistic.
So a lot of the data we get is from Kiplinger's, right? It's a lot of the, kind of, I don't want to say opinions on it, but and tax facts that throw this stuff out there, and they're laughing at it saying that's way too optimistic. 85% is never going to happen.
Yeah.
So you got to figure they hired 5,000 people. Okay. Where'd they put them though? And they don't really tell us what service centers they put them in. They could put 1,000 of them in one service center and spread the rest out across the country. So we'll see. But those are people that are supposed to answer the phone. Period. Customer service. That's all they do.
Here's a phone. Sit here. If the phone rings, pick it up and say,
it rings, pick it up.
IRS.
Yeah. And then say,
how can I help you?
We can't help you, but you got to go to this department.
Right. Yeah. So there's that. But you mentioned that they're going to be trying to go after tip wage earners.
Yeah. So their first announcement for this year, if you want to call it that, typically they'll have 3 or 4 different programs that they throw out. First one that they're going after is unreported tip income. So they're basically going after your waiter and waitresses. In the industry, there's a lot of cash. You'd stick it in your pocket, call it a day. But, I mean, come on.
So let's rewind and just say that when the IRS is going after somebody, by the letter of the law, these are people that either didn't prepare their tax forms properly.
Yes.
Maybe they are suspected of cheating on their taxes.
Is typically where you should have reported $100 in tips every night or every 2 nights or every week, and you didn't.
And they're going after people who, God bless them, they just didn't want to file a tax return this year, last year, or 3 years ago, or whatever.
Yes.
So technically speaking, letter of the law, these people are not.
Yeah, you're not
on the up and up.
They're not on the up and up. But I think it's low-lying fruit for the IRS. It's easy pickings.
But the people, I mean, I've worked in the restaurant industry for years, Jeff. I can tell you right now, it ain't people, claiming all their tips on their tax returns.
No. And even, I won't say the restaurant that's right here, but a very good restaurant right here actually will force every day. They collect tips. They don't care how it comes in, cash, credit card, whatever. And then it's reported on their W-2s. So that way the restaurant owner is not at fault at the end of the day.
One of the restaurants I worked at, and everybody pays credit card these days. So it's unavoidable. The tip's right there. The restaurant logs it, and, I get a paycheck. And,
exactly.
And they take the taxes out of my paycheck.
And there's no cheating in a sense because it's on a credit card. There's a paper trail goes back to that customer's credit card. So they can't say, oh, hey, I got $50, I jammed it in my pocket and walked away.
But when it comes to cash payments,
totally different story.
Totally different scenario. I could throw that in my pocket and say, well, they tipped
what cash?
They tipped me $50, but I can say, boy, these cheapos only gave me
10.
They gave me $10, and boom, $40 hidden from the IRS.
Yes.
I knew a girl, and I'm not going to say her name, but she went to go buy a house. And the bank wouldn't give her a loan because on paper she made $25,000 a year. Well, she ended up buying that house in cash.
Yeah,
Jeff, because and I don't know how the bank was able to kind of look the other way on these things.
Well, they probably wouldn't, but if she was jamming that cash in a checking account, there's a paper trail. That's what they're looking for. So when they say cash, it's just you have the cash in a bank someplace or in some account. And you're wiring it over. It's not that the old days of you're going to bring a duffel bag of cash to closing.
Right.
That will raise a few flags. You will probably be arrested before you get out. But that's what they mean by cash. So.
And this idea that, yes, are they nickel and diming the working stiffs out there? Absolutely. Yeah. But the fact of the matter is this woman was able to buy a house with money that she never let's just say it's $250,000.
Yeah.
Taxed at a 25% rate.
It's a bunch of money.
That's a bunch of money that the IRS is saying, hey, that should have been ours, not theirs. And look, I'm a man of the people.
Oh, yeah.
These hardworking waiters and waitresses out there.
Yep.
They're working their knuckles to the bone. Restaurant work is tough.
Oh.
So if anybody deserves a little break on the taxes and look the other way, it's them.
Oh, yeah.
But at the end of the day, letter of the law, they should be claiming all of those taxes. Yeah. So I think it's nickel and diming, yes.
So anybody listening that works in the restaurant industry, we ran into a case last year. Basically, the long story was client shows up, says, I got all these IRS letters. I don't know what to do. And we look at the IRS letters, and what it is he worked for a place 2 years ago, was a bartender, didn't report his tips. When the place got popped by the IRS, easiest way to explain it, they turned it over and said, hey, these guys never turned in their tip wages to us. Yes, shame on us. We should have reported it, but we did report them a W-2. It's incorrect. So I'm assuming that the employer paid a little bit of a fine, but they threw all the employees under the bus.
Oh.
The problem was the employees couldn't get the data because the ex-employer was not going to give it to them because it could prove that they were wrong.
Right, well.
So all these guys had to pay, $7,000, which was the unreported tip income, the taxes on it, and it was a chunk of change too.
$7,000 just to tell somebody who's a waiter or a waitress or a bartender you owe us $7,000. That's a problem.
It's a big problem.
But theoretically, that should have been put on their wages, and
should have been, and they
paid
should
out every 2 weeks over the course of a
year. And they would have paid the tax on it, a couple of years ago. So it was the original tax plus penalties and interest. And we don't have any way to explain, hey, it was never. They never reported it. It's really the employer's fault versus the employee's fault. I think it's shared 50-50, but at the end of the day, it's your W-2, so it's your problem.
Yeah, at the end of the day, I have to pay $7,000 out of my pocket because over the course of a year, it wasn't taken out of taxes.
Yeah.
So, and it's here's a scenario. If you had an employee, a good employee, they work hard, they work paycheck to paycheck, but, every 2 weeks they're taking $50 out of the cash register. That's as an employer, you're not going to let that stand.
Yeah, exactly. Yeah.
You can work. Down. You can say, hey, what's going on here? Can I help you?
Yeah.
You don't have to steal from me. The government's saying, look, what are you doing here?
Yeah.
This is income for you. You can't just put it in your pocket and walk away.
But you would think that the IRS would come out of the box with something maybe a little more,
less chippy.
Yeah, something goofy like, hey, we're going after this, not the working people. But That's where they're starting.
Yeah, that kid who delivered your pizza, we want him.
Yeah, that's
we want him in leg iron.
Yeah, forever.
Yeah. So I mean, it is what it is. So should these people be paying taxes? Yeah.
Yeah.
Yes. But should we be going after them? I don't know. There might be bigger fish to fry.
There's bigger fish to fry, guarantee it. But that's where they're starting. That's the first one announced for this year. So apparently they have the resources to attempt this or start to try and pull it off. So
well, I'm glad they're going after the real criminals.
Yeah.
and meanwhile, GE is still with their whole building full of tax attorneys.
Tax attorneys don't pay tax.
Yeah, working on a way to not pay taxes every year. Speaking of that, State of the Union. What did Joe Biden say when it comes to taxes?
So one of the things in there is, they want to increase the stock buyback tax. They want to basically, I think, push it to 3%. It's 1% currently. And then the other thing that they were going for, which the unemployment rate, how, they've created all these jobs and all this stuff. And so, yes, the unemployment rate as a number is historical low, 50-year low. I think it's 62, 69 was the last, we were this good, 3.4%. But if you dig a little deeper, it's got a lot to do with COVID. And then it also has a lot to do with, and again, some of these think tanks will come back and say, hey, here's the real numbers. The problem is they're using an unemployment report number that might not be accurate. And not saying, if you look anywhere, people are hiring. So I agree that from that side of the economy, it's racing away. The problem is when they use this unemployment rate, it was based on a 62.9% workforce participation, which means 62.9% of America was included in this calculation. But if you take some other facts that are out there that nobody explains because it gets boring, is in 2022, the IRS actually had more applications for tax ID numbers than they've historically ever had. That goes way back. So you go, what's that mean? It means people are bailing on their day job. Mm-hmm. They're not being really reported in that W-2 category because they've now started their own companies. And that's why they get a tax ID number. So it might be a little bitty, hey, I got a hobby that I'm kind of turning into a day job, or I walk completely, I quit my job, I'm self-employed now. They don't count in the unemployment rates.
Okay. So
that's where you go, little interesting. But again, because we're at such a low, and then the next question is the 62.9% participation rate, is it even right? Is it 40?
Right.
We don't know. But in time will tell on that. But again, so it's not a outright lie by no means. But it's, you say, how factual is that to the economy today?
What stats are you using to
and a lot of our government stats are, they've been doing it for 20 years. Nobody's adjusted them yet. But I think here shortly they may do some little tinkering with the behind-the-scenes numbers for unemployment.
Because I want a real picture.
Yeah,
I want a real idea of what we're looking at. We always talk about the inflation numbers, and for some reason, they take out food and gas prices on that.
Because in 1981, they changed their calculations.
Well, what do I actually buy? Food and gas.
Food and gas. Well, unless you got an EV.
Right.
But still you're buying gas. If you got natural gas pumped in your house. We did the boneheaded mistake of getting gas fireplaces. We replaced our wood fireplaces because I was too lazy to go get wood, drag it. It's cold out. You got to get it off the rack, bring it in. My first gas bill, I was stunned. So, yeah. It was like, maybe we shouldn't have done that.
Right. So the idea is, what are the numbers that they're using, and what's the truth behind
and what's the
numbers?
True numbers behind that, which time will tell. There's a lot of think tanks that are working on this currently, and again, it's too hard to go, oh, hey, it's this, but they'll come to a conclusion, they'll make the adjustment, and then the numbers will be maybe a little bit more realistic at the end of the day.
Yeah. I want to talk about stock buybacks because I heard McGraw talking about it earlier in the week, and it's just an interesting kind of thing that corporations will do. You file for an IPO, initial public offering. You say, hey, I'm going to be part of we were a private company, and now we're going to be a public company. So what happens in this whole process?
So first, you got to understand, as a corporation, how they get their capital to function, okay? Most people don't think about that at the end of the day. But if you are
I think that you sell, 1,000 widgets and you make, $100. That's how you make money.
But on top of that, what the games that get played with their stock. So if you are a privately held company, means your stock, you have stock, okay, because you're a corporation, it's part of the charter. But you're not publicly traded on any exchanges anywhere. And there's some big companies right here in St. Louis that are private companies. They don't trade on an exchange.
So you won't
by
see
design.
them on the
You
Wall
don't.
Street
Yeah, you
reports.
don't see them on any of their wall. You never see a report on them. Excuse me. All of their transactions are private to a degree. But then you have companies that say, "Hey, we need capital, so we're going to go public," which means we're going to sell our shares in a IPO, which stands for initial public offering. So most people, what they don't realize is when that IPO goes down, the company that is selling the shares takes the bulk of the money. I mean, you're talking like imagine Visa going public. Happened 25 years ago. Millions of shares at
I was going to say, how many shares?
$150 a
how
share.
many shares are out there?
Well, that's market capitalization is what that is. So biggest out there is Coca-Cola. And that's market cap. That's the total number of outstanding shares times its share price will give you a valuation. But
like if I looked up Coca-Cola, will there be a number somewhere that says they have 50 million shares?
Yeah, 100 million or something of that.
Oh,
effect.
really? It's that high?
Yeah, it's huge.
Wow.
So
my one share,
you're exactly
don't
one
mean much.
Well, it doesn't, but it does, because again, as you have these huge companies like that, stock buybacks are very important because they issue those shares at the IPO. The money goes into the company's coffers, so it goes right in their checkbooks, basically, and then they do what they need to do. United Parcel Service, as a corporation, was a family-owned private company.
UPS,
till maybe the late 90s. What they needed the money for is they needed a whole new fleet of trucks, and they realized what it was going to cost. So
they might be turning a profit of $1 million every year, but
they
that's
need
not going to buy them
$200 million to buy new vehicles.
Right.
So they do an IPO. So now they have this stock out there in the open market. I mean, the company themselves keeps a little bit. Those are called treasury shares, but they sit on it. And what takes place is, as the company goes forward, if they are extremely profitable, they will buy back shares in the open market. But they typically wait till the market dips a little bit, and they reach out and they buy those shares and bring them back in, and they put them on the shelf. And then whenever they need capital, they don't have to go to the bank and borrow money. They just reach on the shelf, say, hey, sell these 10 shares. They take them out, put them back in the general circulation, and resell them. The money comes right back to them. That's how they get financing, basically. So right now they're saying they're going to do a 1% stock buyback tax, and they wanted to go to, I think he said 3%. The question of the day is that really going to benefit anybody? Maybe in tax revenue. But at the end of the day, that company is going to say, hey, it's cost of doing business, build it back into the products.
So when companies buy back stock, they take the stock out of circulation.
Yes.
And so my stock, one share is worth $100.
Mm-hmm.
Well, if they buy 50% of all the shares, then now my one share is probably doubled.
So that gets into this weird, gets real technical, but gets into a poison pill scenario. So there's a formula built within the total number of outstanding shares that says if any competitor ever tries to buy all of our shares, the shares dilute and they double or triple. And again, it's almost impossible. It kills the company from a share price, believe me. But it will keep that competitor from ever being able to buy. So if you snuck around and bought every share of General Motors, you couldn't do it because you're wasting your time. You could get majority stake, or at least enough to say you're a majority stakeholder, and then force the board to actually move people around for you. But you couldn't take over and get 51% of the shares.
Sure.
It's impossible.
But do they don't take those shares and rip them up?
No,
they buy
they
back.
go right back on the shelf.
So,
and they sit on the shelf.
But when they put them, so my share price doubled. You know, they took a bunch of money out, and they took a bunch of shares out, and now my one stock is worth a lot more than it used to be. But as they go back to put these shares back in circulation,
it could
theoretically my one share will start going down in value.
Depends on how they dilute the total.
Flooding the market.
If they flood the market, then it could dilute the share price, and that's what the companies have to be. And that's what the SEC, Securities and Exchange Commission, sits out there and watches and makes sure that they don't do a stunt like that. But again, they don't want because they're shareholders too, they don't want that share price to fall off the cliff by doing something dumb. But again, you say they're going to create, a tax revenue based upon that 1%, and you go, who's really going to pay it? At the end of the day, I believe that's going to be the consumer. It's not going to be the company.
Well, there's an idea that if you raise taxes on the companies, they'll just pass that on to the consumers, much like the tariffs that they were charging China.
Yeah.
China's not just going to take it on the chin. They're going to
turn around and
raise
push
the
it.
prices.
Exactly.
And all those TVs now are costing a little bit more.
Goes up by $20 and you really don't feel it yet. But if it's multiple, increases at some point in time, you say, hey, I'm not going to spend $5,000 for a TV.
Right.
So.
And I'm only getting taxed on that TV if I buy it.
Exactly.
So
and then you're paying a sales tax, so that gets in a whole nother.
Sure. But stock buybacks, it's 1% now, and they're proposing maybe raising it to 3%.
3% was what he threw out. Now, are those like his wish list? Kind of, you've seen that. You've heard all the different presidents in the past throw stuff out there. We'll see. Again, the problem is there's a lot of stuff was supposed to be voted on, if you want to call it that, adjustments to tax law, and it hasn't seen the light of day. Probably won't until we get past this debt ceiling impasse, which could turn out bad.
Yeah.
But we'll have to wait and see.
So a lot of things cooking right now.
Yes.
It is full-on tax season.
It is tax season. Yes.
So if you need help with your taxes, give Jeff a call.
Give us a call.
636-394-5524, 636-394-5524. Jeff Zufall, Senior Tax Strategist and Wealth Advisor with Capital Advisory Group. And the idea out there is, why would you want to take time on the weekends in February, March, early April, when the weather's just getting nice out there? Why would you want to spend several hours inside going through papers, trying to crunch the numbers? The numbers themselves, it's all Greek to me.
Yeah.
And some of the numbers are Greek,
Some of them are.
Technically. But it's just, it doesn't make any sense to me, and I would spend way more time and effort.
Exactly.
So, what's your time worth?
If it's an easy return, if it's an easy return, that's different. You just have a W-2, that's it. Okay. You can do the free file, IRS's website, key your little stuff in, you're good to go. Anything past that, you may be missing stuff. And again, the tax software, look at it this way, the tax, you buy the software, you have to then spend the time to do it. So at the end of the day, when you do the math, you go, it's probably worth having somebody else take care of it.
Right.
So,
well, here, I'll give you a perfect example. For years and years, my sister did my taxes for me.
Yes.
When I got married, she did our taxes, married filing jointly. Then my wife went back to school. Then we bought a house. Then we had a baby. Then we got an investment property with my parents.
Yeah.
Then my sister said, your taxes are way too complicated.
I'm done.
And did I say, well, we'll just have to do our own taxes now? Yeah. No, I said, I need a tax guy. And that was Jeff Zufall. 636-394-5524. I'm smart enough to know that my time is worth way more than trying to figure out how to do my own taxes. I'm going to get a guy to do that. And while I'm there, Jeff, we're also going to talk about my 401k.
Yeah.
How much money should I be socking away? I added another 1% to my Roth and another 1% to my 401k, and that was off of Jeff's. I'll never miss it. It comes right out of my paycheck. I never even see it. It goes into my retirement account, and when I'm 65, or as Jeff likes to remind me, maybe when you're 70.
Maybe 70.
Maybe when I'm 70 and I finally get to retire, I'll be thanking 41-year-old Josh for upping that by 1% every year. Jeff Zufall, thank you so much. You can do our taxes for us. You can tell us what our tax implication is every 2 weeks when we get paid. And we can figure out, should I do an FSA? Should I do an HSA? What else is out there for me to take advantage of to lower my tax implications so I can keep more of what's mine?
Yes.
Keep what's yours with Jeff Zufall every Saturday afternoon. We'll see you next week, Jeff.
You betcha. Thank you.
You've been listening to Keep What's Yours with Josh Gilbert and Jeff Zufall, Senior Tax Strategist and Wealth Manager at Capital Advisory Group. To learn more, call 636-394-5520.